for joining us today on our webinar Outlook for 2026. And we're sitting here in February, still early in the year. There's lots to cover with respect to the economy and markets. Appreciate you taking time out of your busy day to listen to our webinar today. Get a little bit of thoughts and impact on and input on what we might see in 2026 and how that might impact the things that you want to consider. With that, let's go ahead and get started. Before we talk too much about market impact, we do want to make sure we talk a little bit about the economy and some of the things that we see with respect to the economy. One of the things that we say here is, the more things change, the more they stay the same. We are having a lot of the same conversations with respect to markets and economy that we've been having over the course of last year or the last couple of years. We're going to be talking about the Fed. And we're still going to be talking about the Fed as probably one of the biggest things that's going to impact us as we go through the next couple of years in the market cycle really is inflation and how we handle that. So some of those conversations, we'll talk a little bit about the impact of tariffs and the impact of the One Big Beautiful Bill Act, how that might shake things up within the economy. Those are important things to keep in mind and keep in context as we move forward through this. So what are we expecting for 2026? Well, I think most economists are really pointing to an expectation toward modest growth in the GDP toward the later half of 2026. A lot of it's coming from people think first couple quarters here will be a little bit sluggish. Probably the monetary policy is the biggest factor in that. Again, we're going to be talking more about the Fed and what their policies are with respect to interest rates and how that might impact both corporate spending and bonds or fixed income markets as well. Mortgage rates, all of those things will be kind of tied into the Fed's policy. We also think that there's some business friendly dynamics that may help kind of boost some spending for businesses coming out of that One Big Beautiful Bill Act. And there's also some new deductions available for families. We did a webinar last month on the One Big Beautiful Bill. If that's something that you hadn't had a chance to listen to, it is out on our website. I encourage you to go listen to it. Might give you an idea of some of the deductions that might be available for you this year that you may or may not have been aware of, and how you might want to consider that going forward for 2026. Some of the other kind of lagging effects that's coming off of 2025 is going to be a slowing job market. What we saw in November, December of 2025 indicated that we were having a slowdown in job growth in the US market and softer wage growth. That's probably likely to continue in the first part of 2026 for sure, and may dampen the kind of growth we might see. The other thing that we're looking at always is going to be, again, inflation. We're continuing to see that inflation is ticking a little bit higher. That's definitely going to be something that all eyes are going to be continuing to focus on is what does inflation look like? And then importantly, what does that look like relative to things like job growth and wage expansion? If you start to see that those things are moving in the wrong direction, that could be a bad sign for the economy. So those are things that the economists are really paying a lot of attention to. But overall, really, I think the expectation is that as businesses and households kind of regain footing during this kind of uncertain period, we do expect to see some modest GDP or gross domestic product growth in 2026. Maybe not as high as we saw in 2024, but maybe on pace or higher than what we saw in 2025. So what are some other things that we see maybe tying into the economy or things that we're focusing on a little bit as we look at how fiscal spending and business investment will be impacting our economy over the course of the next little while? Certainly, I mean, the largest share of economic growth is coming off of consumer spending on goods and services. I mean, that's pretty typical. But what's kind of unusual, and we're seeing a little bit of growth in here, is intellectual property growth. So intellectual property is now growing as kind of an overall share to the amount of GDP growth that's expected in our economy. We're seeing that that's expected to be about 7% growth this year. I think a lot of that's coming off of the investments in things like artificial intelligence, the infrastructure around that, the support that that offers to our economy. There's just really an insatiable demand for those kinds of cutting edge technologies, whether it's in business or even in personal use, that we're starting to see more and more of. And that demand is probably going to be a continued pillar of growth in the future. Those companies that we see that are investing in that maybe growing a little faster, outpacing the growth that we see from other companies that maybe aren't leaning into it as heavily. Again, can't talk about the economy without talking a little bit about inflation. Near-term pain, but we think that inflation may improve as we get through 2026. This has been, 3 years on, and we're still talking about inflation. We're still talking about the Fed's policies toward inflation. What this chart is showing you is the services price index is the dark blue line, and then that orange line is the consumer price index, and what we look to measure overall goods and services. Now, what's important to note, when they do that CPI, that consumer price index, orange line, they do back out some things that you and I might absolutely consider as part of inflation. They look at things like they exclude things like grocery expenses, gas expenses. To you and me, that is very much a part of the inflation that we face. But in the CPI, they remove that because there are outside factors that could be impacting the cost of those particular items. So, for example, if there's a drought and that impacts the amount of potatoes that can be grown, the cost of the increase in the cost of potatoes is not really part of inflation, right? It's there's other factors tying into that. So they do pull that out. But I point this out because when we look at where inflation is sitting, the long-term goal for inflation when the Fed looks at interest rates is to have a CPI that is at about 2%. They do actually want to see a small amount of inflation. We see that we peaked in our inflation in 2022. It's come down since, but it's still kind of sticking a little higher than I think people are expecting. It's been around 2.8, 2.9%. Really, what the Fed would like to see that be is closer to 2%. And it's probably not going to decelerate as fast as policymakers would hope, probably not as fast as we would hope. But we do think that the Fed is going to continue some rate cutting. Now, importantly, they met in January, they met in February. In February, they decided to hold rates. They did not give us a rate cut. And what that's really reflecting is that inflation has been a little sticky. It's been closer to that 3%. And they believe that unemployment is still acceptable. So they're opting to hold rates a little bit longer, a little bit higher. There has been some kinds of conversations around maybe the Fed having priced in or having potentially forecasted another 1 to 2 cuts yet this year. Your guess is as good as mine if and when we get those. And particularly now, as we're getting a new Fed chair, Jay Powell is stepping down and got a new Fed chair stepping in. There's a little bit of a guesstimate on whether or not they'll stick to the projections that they've given us, or if they may give us an extra rate cut, maybe less rate cuts. I don't, we don't know. We don't have any crystal balls here. But just wanting us to mention that it's hard to talk about the economy without talking about inflation and how that might be impacting us over time with our investments. The other thing that we often look at when we're trying to identify how's the economy doing overall is really how's housing looking? What is the growth? Economic growth and housing are very often tied together. And one of the things that's important as we look at the housing market is interest rates. Those interest rates, the 10-year treasury is that anchor for mortgage pricing. What you can see is from 2015 through 2024, really what we saw was an increase in those interest rates. We really saw that mortgage rate, the 30-year mortgage rate, that's the orange line there, increase pretty precipitously. It stayed kind of in line with that 10-year interest rate yield. Right now, that when we look at the kind of a rise that we've seen with that, we are expecting that there might be a cut in this over time. If in 2026 we see declining mortgage rates, that might create some extra support for home buyers, may produce a little bit more in terms of returns off of that. So things we kind of look at and evaluate. How is the overall market doing? What's that climate look like? absolutely want to be evaluating not just things like unemployment and our inflation relative to expectations, but they're going to look at things like housing. We're also going to look a little bit at this year, particularly, what might be a little bit new in the conversation is going to be how the US economy really is stacking up against international. So far this year, if I look at market returns from the beginning of 2026 through really today of 2026, you'll see that international markets have actually outperformed domestic markets, which is a little bit unusual. That doesn't mean, though, that there's not some really strong tailwinds for US growth. There still are. When you look at GDP forecasts for different areas within the global market, what we're expecting is that the US and may have a GDP of about 2%. That's higher than what we would expect from the Eurozone. Japan has been kind of undergoing this, what they're calling virtuous cycle. It's really talking about hitting sustainable inflation driven wage growth. That's probably going to keep their GDP a little bit softer. Um, we expect that that may show up even more so in 2027. But as we kind of look at the future of that, there are areas where we look at where we see potential for enhanced growth in international markets, and areas where maybe there's a little bit less opportunity. Overall, the U.S. market looks like it's sitting in an okay position. We have some strong growth opportunities relative to other markets. But one of the things that may be a little bit of a headwind for the US market has been the dollar. The US dollar has softened somewhat relative to international currencies, which has probably contributed to some of the outperformance of international markets, at least over the short term. But one of the things they point out here, the dollar being down but not out, we're still in an upward trend for, if you look at that green line, the US dollar index, uh, we're still in an upward trend for where that was, since 2007. That's kind of been moving upward. There's an expectation that while the US dollar is still is softening some, it's really not in a terrible position overall. The other thing is that when we think about kind of geopolitics and how our economy might be faring over the course of the next little bit, has really been thinking about other kinds of commodity options outside of currency, specifically gold. I have not talked about gold so much since probably 2008. As you remember, 2008 was a kind of a challenging time for us. But when we think about gold, specifically some of the things that that we might want to be aware of here. There has been an increased demand in gold pricing, and that's usually tied to things like volatility. You'll see from this, there's some kind of normalized performance. They'll show you some items there. That blue line represents the gold spot per ounce, and the orange line represents the S&P 500, the largest 500 companies in the US by market share. What you can see is that once tariffs began called Liberation Day, that really bounced the price of gold. Some of this being some fear of the kind of volatility that would create, the pressure that would create in the U.S. dollar, the impact that would have on global markets. The other one being that the OBBBA, or the One Big Beautiful Bill Act that passed. When you saw that passed, you see the S&P 500 increase. We also saw gold increase. Well, why is that? Well, because all those deductions may signal that there may be an increase in the deficit. There's been a lot of concern over the course of the last several years with the U.S. position in deficit. If we're giving larger deductions, could that create more deficit? All of those things are kind of pushing people a little bit more toward gold. One of the things that I always encourage people, though, is gold is a tremendously volatile market. Be careful as you're looking through that to make sure that anytime you're looking at something that's maybe a little bit more volatile, it's in line with your overall risk. So with that, we kind of set the stage for what are we expecting? What's the economy look like? Let's talk a little bit about the stock market. We're going to talk a little bit in particular about the US market. We'll hit a little bit on some of the things that have been contributing to growth in the US market. Well, if there's something that we can take away from this and feel pretty good about, it is that History points to a pretty strong fourth year for a bull market. We are entering a fourth year of a bull market in March of this year that will enter into that fourth year. If we look back, this is showing us a slide taking us all the way back to 1950 and a little before 1950, showing us a bull market year 1, 2, 3, and 4. And in those periods of times where we've had a 4-year bull market, what we see is the average is about a little over 12.5% return in the S&P 500 in that fourth year. The kind of current bull market, the last kind of bull market that we had, where we have started in 2022, and what we're looking at is that we might still see a pretty strong positive return out of the S&P 500 in this year. The other thing, again, got to talk about the Fed again, talking about those interest rates and what happens to the S&P 500 when we get those rate cuts. So I think it's important to think again about when the Fed cuts rates, how does that impact our overall market? Not just how does the Fed, impact bond markets and mortgage rates, but also what does that do for spending for businesses, how they're able to reinvest back into their companies and grow. S&P 500 performance after the Fed cuts are pretty well near record highs. What we're expecting is that when in the past, when the Fed has cut rates, when stocks were at or near record highs, it was about 13% higher on average 12 months later, with most of those companies providing gains. And again, I think that may tie back to those companies being able to, from a financial perspective, reinvest back into their businesses. The other thing that we have to talk about, so when we talk about the S&P 500 and we talk about what we might expect out of that, we've hit on this a little bit earlier as we were talking about the economy, is the impact that AI in particular is going to be driving with respect to the market. Now, when we talk about these hyperscalers, what we're talking about with hyperscalers is going to be large-based, cloud-based service providers, data centers, essentially, right? So Amazon, Microsoft, Google, Meta, Facebook, Instagram, WhatsApp is part of that Meta, Oracle would all be part of those kind of hyperscalers, what we consider for those. And we expect that the growth in those, the compound annual growth rate for those is going to continue to grow. The estimate is just going to grow over about 40%. Roughly right now, a 30% increase over this year's estimate, and a 1.6% of the US economy measured by the GDP. So a lot of the drivers in our economy have really been around AI-focused growth development opportunities. And again, when we talk about that AI, you almost can't talk about AI without talking about the impact that's had on what they call the Magnificent Seven, the Mag 7. You'll hear people talk about with respect to the S&P 500. It's a little bit of background. The S&P 500, again, largest 500 companies in the US by market share. Right now, 7 stocks make up about 35% of the S&P 500, and that's going to be number one. Holding on that is going to be NVIDIA. Number 2 is Apple. Number 3 is Microsoft. Of the top 7, these 3 stocks make up 20% of the S&P 500 overall by market share. So 3 stocks make up 20% of that. And the top 7, if we add in Google, which is Alphabet, Amazon, Tesla, Meta, if we add in those additional stocks, now again, we're looking about 35% of the S&P 500 represented in those 7 stocks. What does that look like for us? What does the forecast look like for us? Well, they've shown us in this little slide. What I like about this is it shows you the Magnificent Seven, just those kind of top 7 stocks. The 35% that I mentioned is in navy blue. And in orange is going to be the entire S&P 500. If there's anything that I feel a little bit encouraged by as I watch this, but if you look at from 2024 all the way current, you're starting to see an expansion in growth from those other companies in the S&P 500. For the longest time, it has been the S&P 500. It has been really driven by the growth of just those 7 stocks. So when we saw the S&P going up, it was really on the back of those 7 stocks. As we begin to see expansion, that's a great sign. But those top seven are still going to be pretty heavy hitters in terms of the S&P 500, its growth and its performance. There is still a pretty wide gap in earnings growth between those and the rest of the S&P 500, and that's likely to continue through 2026. And a lot of that coming down to when you think about the companies that I named, right? Our number one, two, three, NVIDIA, Apple, Microsoft. So what we were talking about in the last slide, right, with AI and AI development, think about the companies that are leading in that. Microsoft, Amazon, which is another one of the Magnificent Seven, Meta, which is another one of the Magnificent Seven. So AI growth is going to have more impact than just how it grows as one slice of the overall economic pie and our GDP. It's the impact it literally has on things like the S&P 500 and what we use to measure market growth kind of on a more real day-to-day basis with respect to looking at investments, maybe looking at things like what's in your 401k plan. All right, so we've hit stocks. One of the things that we kind of want to chat through, which kind of gets a little bit into the economy, the impact of midterms in terms of stock performance over the course of a market cycle. Generally speaking, years that have midterms are more volatile market years than years that are not. If we look at the S&P 500 again, taking us from 1950 to current date, if we look at the first year of office, the average return of that was a little bit better than 12%. If we look at in a midterm year, that's cut to about 5%. It's a modest gain with a much bigger potential average drawdown than what we typically see in normal market years. Now, keep in mind, when we talk about market drawdowns or sometimes pullbacks, we'll hear people talk about that. It is not uncommon for us to have 1 to 3 pullbacks in a market that are 10 to 15%. And that can feel really jarring and a little scary. What I point out to you is that it is pretty typical in any normal market to see that. And if we see that in a normal midterm year, we may have a larger drawbacks. It is possible for us to see some pretty significant volatility in 2026 that might really shake up the market on a short-term basis. So generally, when people think about, well, how do I protect myself in markets that are going to be volatile, we look at things like bonds and cash that help provide us a little bit of insulation against the S&P or against the market and market returns. Bonds are absolutely something that we'll be taking a deeper look at here and what we might expect to see within bonds. Overall, what we're seeing is that Fed's rate cutting campaign might end here in the next little while. So in the second half of 2026, we may get to a point where the Fed's reached the place that they want to be with respect to interest rate cuts. As I mentioned earlier, we did have a change in our Fed chair. That may impact it, but everything that they forecasted for us in 2025 indicated we might get maybe 1 or 2 cuts in 2026, but probably unlikely to see significant cuts. That may be long-term appropriate. One of the things to keep in mind there, when we look at the US, the 10-year Treasury is really highly correlated to the expected funds rate, Fed funds rate. So you can kind of see, and they tie really closely. They'll be pretty close as they kind of line up through that. When we look at where we think that the market might be, the market kind of is suggesting right now that the Fed's rate cutting campaign may put us at a kind of a low point of about 3%. And if that's the case, then we would expect to see that the 10-year will correlate with that pretty closely. So when we think about bond, right, and we think about bond and how we're going to get returns in the market, there are 2 things that we look at that help us generally identify the kind of return that we might expect in a bond. One is going to be its credit quality, and the other is going to be its duration. One of the biggest risks to market is interest rates. So bonds have an inverse relationship to interest rates. As interest rates go up, bond prices go down. As interest rates go down, bond prices go up. So if we feel like we might be to the end of a Fed rate cutting cycle, maybe get 1 or 2, we're probably going to see maybe a slight increase in fixed income, but probably not a whole lot additional return off of that. Now, I mentioned earlier, right, one of the ways we get the returns off of those is going to be through duration. How long does it take for my bond to mature? Generally speaking, the longer it takes for my bond to mature, the bigger swing I'm going to see off of its return relative to those interest rates. So if I was looking at a short-term instrument, something that would maybe mature in the course of the next year, and the rate cut happens, I'm probably not going to see much movement at all in my bond price. I'd probably be more likely to see that in something that has a longer duration. So the other thing that people might do if they're looking to have some positive return off of their bonds is to look at things that have different kinds of credit quality. So credit quality is the other way that we get return off of bonds. Generally speaking, the lower the credit quality, the higher interest rate they need to pay us, right? So if I think a company is less likely to be able to meet its needs, it's going to have to induce me to buy by maybe giving me a little bit of an incentive rate on those on that bond in order for me to go pick that up. Or things that have higher credit quality, what we call investment grade, don't have to get as much because people are going to be more incented to buy them on the idea that they're less likely to default on their payments. What this is showing you, so this little sharp chart here, what this is showing you is that in the past, the kind of blue, the range of option adjusted spread, like how much could I expect to get of different kinds of credit quality. Generally speaking, the lower the credit quality, the bigger spread, the higher potential positive return I have of that. So for example, if I look at high yields are going to be things that are under credit quality rating. Similar to that triple C rated bonds, those are going to be things that are lower credit quality. They're going to have a higher range of potential return for me. Again, going back to, I don't know that somebody's going to repay me, they're going to have to incent me by giving me a higher interest rate. Investment grades, the things that are higher quality, should be things like double A, triple A, triple B would be in this as well. Double Bs, even B rated. B rated gets a little bit lower in credit quality, but still pretty solid. Those tend to have a lower spread, a lower potential return in the market. The little orange square that you shows us kind of where the current spread is, the current option adjusted spread. And what we're seeing is that right now, a high yield bond, something that has a higher potential that it might default on me, is pretty close in annualized return in the spread to a corporate or to an investment grade bond, which might mean that it's just not worth it to take a whole lot of excess risk in those bonds for the relative return that we're getting. So at the moment, we're kind of a little bit of an anomalous situation in which interest rates and credit quality kind of aren't paying the way that we might expect. This is where I think you've seen a lot of people who have then opted to stick into the market, stick into stocks, as opposed to picking up lower credit quality bonds. So if I'm trying to build a portfolio for myself and I'm looking to get kind of a wide range of return, I might not add a whole lot of high yield or below credit quality rated bonds because it's just not paying me to do so. I might instead just take on a little bit more equity risk. But those bonds, corporate rated bonds, are still, or investment grade rated bonds, are still potentially worth carrying to provide us that overall diversification. Now, in terms of kind of hypothetical returns, what kind of interest rate could I expect to get off the bonds that I have? We've put together a couple different scenarios for you. Best case would be our bull case. Base case would be kind of what we think expectations are reasonable for. Bear case would be considered something that would be maybe if we have a contraction in the economy, if we start to see a pullback in the market, if things aren't looking so rosy, and kind of where the break-even rate change kind of takes us from one to the other. So we're going to use just one index as an example of this to kind of walk through. We're going to use the top one, the Bloomberg US Aggregate Bond Index. It's one that we use very often to measure intermediate term bonds, so bonds that have a duration in the middle between like 5 and 7 years of duration. So not super short term, not super long term. When we look at that, what we might expect if we get a 1% pullback in interest rates, we might see in a bull case scenario a 9.9% return. If we just get 0.5% in rate cuts, that might be still a 7% return. If we get no change at all, we expect that that might be a little bit closer to 4%. Let's say that the Fed decides it's actually to raise rates. Well, that would probably cut those down to 1.6%. And if they raised it 1%, we might be looking at a negative return in that scenario. So just to kind of give you an idea of where, when the market's looking at kind of the overall risk associated with bonds right now, if I was looking at an intermediate term bond, my overall risk is probably sitting at, if they raise rates, it could be a little bit negative to, if they lower rates, it could be a pretty good year for those bonds. So we've covered a lot, right? We've talked a lot about the economy, we've talked about stocks, we've talked about bonds. What are some considerations you should take away from this with respect to your 401k or maybe investments that you have elsewhere? Well, I would always encourage you to go back to making sure that your allocation is appropriate for you. So that's going to be looking at things like, what's your time horizon? Do I need to take money out in the next 2 years, 6 months, a year, or is it 10 years, 15 years? The longer that I have, you can see this, the probability of S&P gains in the chart piece to the side. The longer I have to go, the more likely it is that I'll see positive returns out of the market. If I look at any 1 year period since 1950 going forward, this is through 2024, there's about a 74% chance that I made money in that 1 year. But if I look at over a 15-year period, there's a 100% chance that I probably made money on that. So longer term to invest, the likelihood that I have a positive return is higher. There's no guarantees, but generally speaking, the longer we have to invest, the more likely we are to see positive returns in the market. But we need to make sure that we look at our overall comfort with risk. Are we comfortable if in the near term we see significant volatility? Like we talked about this being a midterm year, there's significant possibility that we might see a good drawback. And if that happens, how are we going to feel about our account? That's going to make us stay up at night. We're going to feel all kinds of anxiety with respect to that. We're going to want to make sure that our allocation is not just mutual funds that own stocks, that maybe we're more diversified than that. That's a good thing to keep in mind in almost any case, is making sure you're well diversified. Another part of that might be, if we look at areas for potential expansion, as we talked about earlier, there's a pretty good case for emerging markets or international expansion. All I have is US stocks. I might want to have a little bit in international as well. We want to make sure that we're keeping an eye on the appropriateness of our allocation to risk. And really what I'm talking about here is rebalancing. So what happens over time is that maybe we set up an allocation that was perfect. We felt comfortable with. It was something that, from a time horizon lined up, we're comfortable with the amount of risk that it carried, and we were well diversified. But if we've never looked at it since then, what's going to have happened is that we're probably carrying more stock than we thought we were. So if we don't rebalance and bring ourselves back to that initial target, we could be putting ourselves in a position where we're carrying more risk than we anticipated. If you have questions about your specific situation, you feel free to give us a call. More than happy to help. Lastly, we want to make sure that we stick in a disciplined approach to investing. So what that means, we want to make sure no matter what's going on in the market, we're not overreacting to that. Again, keeping our eye on the long horizon. Not going to be investing for the short term, but rather investing over a long term. We want to make sure that we are comfortable with the risk, that we've taken a look at our allocation, that it is appropriate for where we're at, that we've rebalanced if we needed to. That's a part of that discipline. The other part of that is what's called dollar cost averaging, which in a 401k plan just means we're going to contribute every time we get paid, right? That's going into our investment, no matter what's going on in the market. We do those things long term. The data all suggests that we'll be in a better spot by kind of following that approach to investment. That is everything that I have for you today with respect to the market, the economy overall. If there are questions that you have for us, we really encourage you to reach out and ask. We're happy to help in any way that we can. Thank you so much for joining. You have a wonderful day.